Chapter 2. Analyzing and recording transactions. Analyzing and posting process. In the realm of accounting, the initial step involves the identification of business transactions and events. For instance, in the UAE, a company might invest significantly in a new property in Dubai. This transaction is then analyzed to determine its financial implications. The effects of this transaction are then recorded in the company's books. Over a period, these individual records are collated and summarized, resulting in comprehensive financial reports and statements. These documents are pivotal for stakeholders in the UAE, such as investors considering investing in the booming real estate sector or banks deciding on business lending terms. Source documents. Source documents serve as the primary evidence of business transactions. In the UAE, an example of employee earnings could be the monthly salary slip of an employee working in an oil company in Abu Dhabi. Checks might be issued for various purposes, such as paying suppliers or settling utility bills. Bills from suppliers could be for goods imported from other countries. Purchase orders might be raised for procuring machinery for a manufacturing unit in Sharjah. Bank statements would reflect all the financial transactions, and sales tickets could be receipts from a retail store in one of Dubai's many malls. The account and its analysis. In accounting, an account is a structured record that tracks the changes, increases, and decreases in financial values, such as assets or liabilities. For instance, a company in the UAE might have an account specifically for its fleet of delivery vehicles, which constitutes an asset. The general ledger, on the other hand, is a consolidated record of all such accounts. The fundamental equation in accounting, especially relevant for businesses in the UAE's dynamic economic environment, is that the total assets of a company will always equal its liabilities plus equity. Asset and liability accounts. Assets are resources owned by a business that can provide future economic benefits. Building and land would be significant assets for a real estate company in Dubai. Conversely, liabilities represent what a business owes. If a tech startup in Abu Dhabi borrows money to fund its operations, it would record this as notes payable under liabilities. Equity accounts and its analysis. Equity represents the owner's claim on the assets of the business. In the UAE, where many family-owned companies, the owner's capital and withdrawals would be significant equity accounts. Revenues from selling luxury goods in Dubai's shopping festivals increase equity, while expenses, like operational costs, decrease it. Ledger and chart of accounts. The ledger is akin to a database of all financial accounts. A large conglomerate in the UAE might have a more extensive ledger due to its diverse operations compared to a smaller enterprise. The chart of accounts is an organized list of these accounts, each with a unique identifier, aiding in streamlining the accounting process. Debits and credits. In the accounting world, every transaction affects at least two accounts, represented using T accounts. For instance, when a business in Dubai purchases inventory on credit, it would debit its inventory account and credit its accounts payable. Double entry accounting. This system ensures that the accounting equation stays balanced. That is, assets will always equal liabilities plus equity. For a trading company in the UAE, when it makes a sale, it would debit its cash account, which constitutes an asset increase, and credit its revenue account, which represents an equity increase.